Okay. Okay. That'll just help me keep on track a little bit, because otherwise I'll just get off track and be done in like 4 minutes. So I'm really bad about that. So as I said, we are a rehab lender for real estate investors. We just do the short-term piece. And Serena asked me to put something in talking about what I'm seeing as far as current trends and the market goes. We are definitely seeing that inventory is low, and this is true in every market we currently lend in. We've been doing this for about 20 plus years, started out in Denver, which is where we're headquartered, and is just super competitive everywhere. We have a lot of markets that are way more expensive, like Denver and the Pacific Northwest, but they're still super competitive. So we're seeing that everywhere, and that deals are hard to find. Just some sources that I put down here were how I see my clients getting deals these days, still through some realtors, wholesalers, probably much more than ever before, everywhere. And then I'm seeing a lot more on social media. Excuse me. So this is who we are. We're just a mortgage company that was founded in 1961. It originally started doing like timeshare financing. So it's always been sort of creative and outside of the box. And for 20 plus years, we've really been focusing on the fix and flip and fix and hold investor. And that's really all we do today, other than some short-term commercial stuff. And then, you know, we just do the niche financing, short term. We lend in several markets now, including the Kansas City, Missouri, and Kansas, as well as some others that I've listed here. And I'm just not going to read to you guys. So I just kind of want to give you a little bit of an overview. And then for myself, I've been with merchants since 2004. And before that, I worked for 2 different banks for about 12 years each. So I have a lot of banking experience. Recently, I moved to Kansas City from Colorado just in April. And I have 2 rental properties here in the Kansas City market. I've been coming out here for about 5 years, roughly. And so several years before we even moved here, I did buy 2 rental properties because you can actually cash flow here, which you cannot do in Denver.
And the house that you bought was actually from a flipper, a local flipper, correct?
The one I live in, yeah.
Correct.
So, right, we moved to Lenexa and I bought it from one of my clients who I financed it for, and then bought it from him. And he is a rehab flipper that I've done about 16 deals for. So then I wanted to talk about using short-term financing. Of course, you can use it for fix and flips, but you can also use it for the BRRRR strategy. And I have a lot of clients that do this, again, more in the Kansas City market than in the Colorado market. And I do still have a lot of clients in Colorado. So I did define what BRRRR is. Probably most of you know what it is and are already doing it, but I just wanted to put that out there in case someone did not. And then just talking about using short-term financing, which would allow you to buy the property and only put potentially 10% down. So we lend up to 90% of the purchase price, plus up to 90% of the rehab, subject to at least a 75% loan to value on the ARV. So instead of buying a property and going right to conventional financing where you might have to put 25% down plus finance your rehab out of pocket, this could allow you to go in with as little as 10% down and then refinance it out so that you can then preserve your cash and, you know, do it over and over again for the repeat part of the BRRRR. Anybody have any questions? I just don't want to rattle on if you have questions.
So what's the term on that one? Like, can you talk a little bit more about the 90%.
So, so we would lend up to 90% of the purchase price, plus up to 90% of the rehab. And we would do it on a short-term loan, which could be 6 to 12 months, interest-only monthly payments, and no prepayment penalty. And then you would refinance with a conventional lender if you were doing it as a hold. Does that answer your question?
Okay, so when you say 90% of the rehab, so it's like a rehab loan, not just a mortgage?
Yeah, I mean, it's still a mortgage, it's still a lien on the property, but we're lending you a percentage of your purchase price and a percentage of your rehab all in one loan. And then you do construction draws as you do the rehab.
Okay, that makes sense. Are there
Okay.
specific criteria to qualify for that?
Yeah, so I think I even have this maybe on one of my slides, but yeah, right here. So my second bullet, we have make sense underwriting. So we're looking for borrowers with good credit history, good liquidity. You have to have enough liquidity at least to support your down payment and closing costs. And we do like that you have additional reserves. If you were to go over budget, something came up you weren't expecting, those types of things. And then we like to know any experience that you do have. So those are kind of our three major criterias. Given that, we do work with new investors all the time, but at that point, we would like to know, understand like how are you going to get it done. So like if you're working with somebody like Serena, who would be the person to help you find the deal and then help you through the process, that's sort of a mentor situation, and we're totally fine with that as long as you have the other qualifying criteria. Does that help?
Yes.
Okay.
Thank you.
Sure. So, I have here that we're easier and faster than banks or conventional lenders, and that we're less expensive than hard money. So that gets back to my original thing where I like to call us mushy money or squishy money. But just, we're not as expensive as most of the hard money lenders out there. There's new competition all the time, so that's not always true, but for generally we are less expensive than like a Crossroads or something like that. And then we do pre-approve borrowers all the time, which is great for people who don't know if they could maybe meet the criteria or don't know, what we might be able to offer them. And then once you are pre-approved with us, we're able to give you a lender letter. So that really does help. I think Serena could probably agree that helps a lot of times with the seller, to give you maybe that little bit of an edge, in addition to that you can close quicker, not necessarily than a cash offer, but then some of the other people who are obtaining financing.
Well, and that's absolutely essential right now, I think.
In
One
this
of
market.
your clients I'm actually working with, and then they asked me on top of that, do I have a relationship with the lender?
Hmm.
I mean, they really want to know this is going to close.
Right.
So,
And I get people every once in a while that'll call me and be like, can you just give me a lender letter? And they haven't submitted anything yet. And I'm like, no, because then, my letters are no good now for all my other clients who have really gone through the process and done what they should have. So no, I'm not willing to do that. So we truly do the due diligence before we will issue a lender letter, because we want it to, we don't want to ruin our reputation, and, you'd probably prefer that we don't ruin yours. So, so that's how we look at that. So it's very important to us, to do what we say we're going to do. We've been doing this for a very long time. We have a good track record, and I have a lot of good references. So it's nice that people can depend on what we say. Now, can we close every single deal all the time? No, because, things might happen, but we probably close 96% of the deals that we actually get started on and get through the process. We just don't mess around with stuff. So if it doesn't appraise, then it's up to you as the investor. If you want to back out, see if you can get the price reduced, or move forward and just bring in additional. And I have had borrowers do all three. And it's not very often that they don't appraise. Sometimes we get in a crazy market, and we are in a crazy market right now, but right now I can't even think of the last thing that didn't appraise here in the Kansas City market for my deals. So, so that I have not seen that as an issue. Over the years, I have seen it as an issue in markets that just can't keep up with what people are willing to pay for stuff, right? Because the appraiser has to be able to use something to support the value. So over the years, we've seen it as an issue, but I really haven't seen it here in Kansas City yet. So let's hope that continues. But you know, my people are buying stuff right. So if they're buying it right, they're getting the deal, they're putting the right amount of rehab into it. If they don't overspend, you know, it is working and it is appraising. So far. Hope I didn't jinx myself. So anyway, I'll continue on unless anybody has any other questions. Okay, so we're able to close quicker than most of the other traditional lenders out there. Typically 2 weeks is like super comfortable for us. If we need to do stuff faster, we have been able to. A lot of it really just depends on how my appraiser, you know, if they can get in there. So far, I only use one appraiser here in Kansas City, and he's just been awesome. And they've done stuff in a couple of days for me. Now they do charge you a little bit more, you know, they will charge a rush fee, but I've been able to do it, but I really try to give him a week. So any deal I can give him a week on, I do, so that when I really need a favor, I can call it in, and I'm not calling in a favor on every deal I give him, because then maybe he won't do it for me. So far I've really been able to do the 2 weeks like super comfortable, and I've been able to do faster when we really needed it, as long as the borrower is cooperative. So then, oops. So then I think I just lost where I was. There we go. We're able to lend on all property conditions, so that's not an issue for us. We do minor cosmetic all the way up to even ground up we've done, and major construction. Now, ground up and even major construction, we may not do 90% in all cases. So you want to be prepared for that. Sometimes we'll scale it back to 80. And then I think I've already talked about, well, I talked about that we have make sense underwriting, but we're also very flexible when it comes to income. I have borrowers that aren't employed at all. I have borrowers that have negative AGIs. None of that stuff really bothers us. So, you know, we just look at what really makes sense for how you can make payments on the loan. We have no DTI requirements at all. So just looking for you to be able to service the loan. And even if we're using liquidity or line of credit availability, that works. And then we can close in entity names. Personal guarantees are required still, except when you're using an IRA and it's a non-recourse loan. But in that case, we are going to require more down. We're never going to do 90% on a non-recourse loan. And then we have the ability to cross collateralize. So if you have a property that you own, say a rental that's owned free and clear, we usually do on a first position lien. We will look at using that equity in that property so that you don't have to come to the table with any cash to close. And then I've been saying that, you know, we've been doing this for a long time. So obviously we're very experienced in rehab lending, and we do understand working with investors, and we actually love investors. Okay, so then I've already talked about, we do the 90% of purchase price and 90% of rehab. The second bullet I left in here, but I have to say, since COVID, I don't see this really helping my clients much. We have something that we call a down payment reserve account. And before COVID, we were using this quite a bit, where people would still bring their down payment to closing, but instead of having it reduce their loan amount, we would hold it back in escrow. So we were doing a loan for 100% of your cost. But since COVID, I'm seeing all of the conventional lenders that my clients have been working with doing the look back and really looking at what you actually paid for the property versus just what your lien is. So that's really not seemed to be a good strategy lately. So I'm really not marketing it, but I would guess, it'll come back, right? Everything goes away and everything comes back. So I kept it in there so that, it's an option. And if you're working with a lender, I always tell people if you're lining up your conventional lender ahead of time, which is a really good idea. If you're buying a fix and hold property, you can talk to them about this, and I'd be happy to talk to them about it. And if it's something that can work, then we can work together to make sure that that strategy makes sense for you. But the last few I've done, it hasn't worked out. And my borrowers have actually ended up deciding just to sell the property because they didn't want to mess with refinancing when they couldn't get as much out of it as they wanted. And of course, it's a good market to sell properties. So they just decided to move forward on that. So I'm really not marketing it, and I'm really not using it very much right now, but I just sort of wanted you to know that it's something that is available, and I can't imagine it won't come back as things start to loosen up. And so our typical interest rate is 10%. It is lower for borrowers that we have a relationship with. So as we do more deals for you, we can lower that. At least we have been able to. And it is higher for smaller deal amounts. So usually I don't like to write anything under 100,000. But if I do, we would look at probably at least 10.5% on the rate. And then same thing with the origination fee. We're generally 2 to 2.5%. But higher rates and fees apply to lower loan amounts if we agree to do them. Sorry. And I do have a minimum origination fee in all cases of at least $2,500. And then we write the loan. Oh, sorry, go ahead.
I just want to mention that these are really competitive. I don't know if anyone else has talked to any hard money lenders, but these are really great rates. So especially if you are very new, but like she said, has a mentor or somebody willing to help you, this is phenomenal. So
so that's why I call it mushy money and not hard money. Thanks, Serena. And then the loan is, it is a 12-month loan, but I like to market it as a 6-month loan because if you go beyond the first 6 months, there is an additional extension fee built in, which is added to your payoff. So it starts getting more expensive after those first 6 months. So I like people to think of it as a 6-month loan so that when you get a payoff 9 months in, you're not like, what the heck? Why is it this much higher than my original balance? I'm really not into surprises. I really like people to know what they're getting, know what they're paying for, and understand it rather than going back and saying, oh, well, yeah, I told you it was 12 months, but it really wasn't. I just don't work that way.
So I just talked to an investor. It was 2 nights ago, and we were looking at 64109, and it was looking at a 5-bedroom, 2-bath. And what was really important about our conversation was the average days on market for that size house in that neighborhood was anywhere from 100 to 145 days on market.
Wow.
And it's not, yeah, it sounds bad, but at the same time,
these days,
there's comps, they're selling. It's just the size of the house, the age of the house, the neighborhood. But the important thing was having the conversation up front. Those are the kind of things that I talk about up front because I want you to be prepared for that. I want you to build those into your numbers. You have to be completely prepared to keep that house on the market for 145 days.
Yep.
So that's what's really important talking to an agent, getting all the information and making sure you're prepared for that.
Right. And it's funny because I talk to so many people, and especially in, like, as I said before, all of our markets right now, like everything's moving fast and they're very competitive. So when I tell people, oh, it's the 6-month loan and then you have the 6 months extension, they're like, oh, I won't even need that, and they're not listening to me. And I'm like, look, I'm telling you right now, because you're going to call me and say, I don't remember that. And I'm going to say, yeah, remember I told you about it. And then you said, well, I wasn't going to need it. So you just like shut me off. Like they don't even listen. It's funny. And I've been doing this a long time. And so it's not the first time I've seen it. Trust me. So I really just try to, really drill it into people, and not because I want them not to succeed and, whatever, but it's just important to be prepared and at least understand what you're doing up front.
Susan, can I ask you a question on that?
Sure.
Is it a flat fee? Is it a percentage?
Oh, the
extension?
extension fee, it's 1/3 of 1 point per month.
Okay,
It's not cheap.
thank you.
So if you end up going a whole year and you started out at the 2% origination fee, it ends up being 4. 2 on the front, 2 on the back, basically.
Okay.
Does that help?
Yes.
I have a quick.
For me, I understand numbers better when I see them in front of me, but yes, that helps. Thank you.
Sure. And actually I was done. So there's my contact information, and happy to answer any other questions.
Well, Susan, maybe we can actually do that for the Facebook group after, or maybe tomorrow we'll meet together and maybe run some numbers
Sure.
and like what it looks like for like a $200,000 house.
Of course. Yeah.
That'd be really great because I'm the same way. I'm very visual.
Yeah.
Like I just want to see how it would look and actually work out.
Yeah. No problem.
That'd be great.
I was gonna ask about like the 90% of the purchase price, the 90% of the total, like that, if we include that in the math, because it'll make sense. And I don't know if I do that right when I'm running.
Yeah. Yeah. So what we can do is we can do, hypothetical purchase price, rehab amount, and then assuming you would qualify at 90%, then we would, do the loan amount, the origination fee, just kind of work through it, the needed appraisal amount, we can just kind of work through all of that.
That'd be great.
Yeah.
And then, so do you also require scope of work in the
Yeah, we do. Yeah. So a line item budget. Mhm.
I have a question about the
Mhm.
1-year loan, because sometimes it's not always guaranteed to get a refinance or something like that. So after 1 year, do you automatically continue the loan, or what happens?
So after 1 year, you do need to apply for an extension. And I say apply, but it's like super easy. I'll usually call people a month and a half before their loan matures and say, hey, what's up? If we haven't talked before that, which sometimes we have and sometimes we haven't. Just, hey, what's up and what's going on with the project? And do you think you'll need an extension? And easily I can get you 3 to 6 months on a first extension. Very nominal extension fee, like $250 to $500, but that deferred fee continues, right? So that extension fee of 1/3 of a point per month is going to continue each month, and that just gets tacked onto your payoff. So that's the expensive piece of it, and you still make your interest payments. And that's as long as you've been performing on the loan. I haven't had any problem doing that for any of my borrowers. So, it is definitely in your best interest, because it is a short-term loan and is priced at a short-term loan, is to get your refinance as quickly as possible if you're planning on holding the property, or if you can't get one, to consider, should I sell this thing?
Mhm.
So those decisions are all up to you, but we will definitely work with you as long as you're performing. We have no interest in foreclosing on your property or anything like that. It's in our best interest to continue your loan, but we do have to have a conversation, and you do need to let me know what's going on, and then take the steps that we require to get the extension done.
One more quick question. Do you do loans on just the rehab? Like if I already bought a property, I'm already rehabbing it and need like a loan to finish?
It's not our favorite thing to do. I won't say we've never done it, but it's not our favorite thing. So we'd have to have kind of a case by case conversation.
Okay,
Okay.
thank you.
Mm-hmm.
I had a question.
Sure.
So is this like strictly an investor type of product, or can an owner occupant use it as well?
No, it's totally investor.
Okay.
Yeah.
I was just,
'Cause, 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 'cause,
Hmm. Samantha, were you maybe thinking of like a home equity line of credit? Are you trying to remodel like part of your house for the Airbnb?
I have the cash for the remodel on that. What I was thinking about is one of my clients. We've gone through a purchase in Overland Park, and very last day of closing, the underwriter denied their loan, and they kind of need about 2 to 3 months to get their paperwork together to qualify again. And
Yeah,
heartbroken over that house. So if something like this was available,
right,
he probably would have qualified for it just to get him in the house, and then
right.
mortgage would have been, you know, qualified for a mortgage again, then he could have refinanced out of it. So that's kind of why I
Mhm.
asked that question.
Yeah, I get a lot of calls for that sort of thing. And honestly, before Frank Dodd, we had some some availability to do that if it really needed rehab, or if they couldn't qualify or whatever. But when Frank Dodd came along and ruled out the purchases as being exempt, we just can't do it because, we don't do TRID and we don't do the proper consumer disclosures. So there's just really no way around that.
That makes sense. Now that you mentioned HELOCs, do you guys do HELOCs too?
No,
Okay, that's what I
no.
thought.
Yeah.
Okay, thank you.
Thank you.
Hey, Susan, a minute ago when you were talking about extension fees, did you say it was a third of a point per month, or is that what you said? So if
Yes,
you go, if it's a 6-month loan and you go to 7 months, you just pay the third of the point at closing on the 7th month.
that's correct.
Okay, thanks.
Thank you.
So what about if they need like another loan on top of it to finish it?
Yeah, we won't do that.
You don't do that? Okay.
No. No. So you really want to make sure your rehab budget, includes everything you really needed to do in the beginning. And
Right.
if you have cost overruns, you need to be able to support those out of pocket, which is again why we like to look at your liquidity and make sure you have additional reserves. I
Right.
have had people go in and get seconds to do that. And, we can't stop you, but it really becomes a huge problem if you can't get us paid off before the loan matures, because if you have another lien on there and you want us to extend, it's like a nightmare.
Got
So
it.
don't do it. So yeah. I mean, you can call me and we can talk about it, but my advice usually is going to be to try to find somebody to take out the whole thing. So pay us off and give you the additional money that you need. But just really try not to go over budget.
Right. Well, and so when you guys have somebody look over the scope of work, do you guys kind of try to, do you make comments like that?
So
Say,
what
hey, labor's kind of missing. There's not dumpsters, what?
Yep. I know. So if your rehab generally is under 50,000, we're really not analyzing your budget very much. Okay. So the appraiser is going to go in and appraise it based on what you say you're doing on your scope of work. So if the appraisal doesn't come in high enough because you're not doing enough, then that might be a red flag, right? Now, if your budget is 50,000 or over, generally, everything's general, right? But generally, we also require what we call a pre-cost analysis, which is where we have a third-party inspector come out and look at your budget and what needs to be done in the house and make sure it seems reasonable. So that's where you would get those comments that Serena was asking about, where they're going to say, this line item doesn't seem high enough. I don't even see anything to cover this. And we do require a contingency. So, they're going to give you some fluff on, well, if you don't have this in there, maybe your contingency will cover it, as long as it's, enough. So that's where that comes in. So, we do a little bit upfront on that stuff by doing the appraisal and having the appraiser appraise it based on what you say you're going to do. And then also that second step of the pre-cost analysis for a budget over 50,000. But there's a lot of room in there, right? Because I have borrowers that do all the work themselves. I have borrowers that hire everything out, and I have borrowers in between. And my inspector and my appraiser don't know any of that stuff, right? They don't know if you're going to be swinging the hammer yourself or if you're hiring everything out. So, there's some wiggle room in all of those numbers. So it's really up to you, first of all, to do your due diligence and do the best job you can at making it make sense based on how you're going to be managing your own project. And then we're just sort of a second set of eyes, but we never want anybody depending on our opinion of whether your budget was adequate or not if you've run out of money. So I don't
I'm
know.
sure you have
I almost sound like a lawyer, and I'm not
Yeah.
trying to.
And I'm sure you have nobody arguing with the appraisal, right?
I don't get much of it, honestly.
That's
I
one.
can't. Yeah, he's really good.
Okay.
And I can't say, we've never gone back and argued, but I've gone back a couple of times and said, hey, do you have any room? And hey, can you look at these comps that my borrower was looking at? And he's moved it sometimes.
Yeah.
So, but
That's
I honestly don't have it happen a lot with this guy. So I'm like so happy with him. I just do whatever I can to keep him happy because, he's been doing a great job for me. And it's hard to find that, let me
Right.
tell you. The first two I had out here, I was about ready to shoot them. So it's not easy, but you do need a second set of eyes for stuff. And I can't tell you over the years, more in Denver with this, where I've had people that argued with the appraiser, came in and brought in extra money, and the appraiser ended up being right, and they ended up losing money on their deal.
Right.
So, sometimes they're not always wrong.
And then what does the draw look like? What does that process actually look like?
Sure. So on the draws, we advance, you can ask for an advance for up to 1/3 of your budget, capped at 30,000 for right after closing. And it's just an initial advance, so you don't have to have work done, receipts, invoices, anything like that. So that obviously gets you started on the project and moving forward. And then when you have your next draw request, we are going to send out that inspection company. And if we've had the pre-cost analysis, we try to send out the same inspector as long as they're available, but it is the same company. And then they do a line item percentage of completion. And so then if you had requested that initial third, say up front, we're going to be looking for it to be at least 1/3 done at that point. And then we can advance another third. And if you spend any more of your money out of pocket, you can get that as well. So it's not like your draw is not limited to 1/3. It's just limited to 1/3 advanced over percentage of completion. Does that make sense?
Yeah, no, absolutely.
And then once you're requesting the remaining money in the account, then we want it to be at least 85% complete.
Got
And
it.
on your subsequent requests after that first initial advance, you do have to have receipts and invoices as well.
Right. Yep. And does that include utility or anything like that? Or is it just material and labor?
Just material and labor. No interest, no utilities,
Got it.
no really soft costs other than like permits if you've had them in your initial permits plans, if you had them in your initial budget. But other than that, we really don't like to pay for soft costs.
Got it.
I have a question.
Yeah.
So with the points, do we pay those up front as a part of the closing costs, or do they go with a payoff of the loan at the end?
No, so the points you pay up front, all your closing costs you pay up front, and then the only thing that adds to your payoff at the end would be late fees if you have those, or those deferred extension fees if those
Got it.
apply.
Thank you.
Thank you.
Question, Susan. One of my things that stress me out when I'm under contract is, losing my financing. So
Yeah.
I want to avoid the situation that Samantha's client got in. So what are the, theoretically, if I'm pre-approved, what are the reasons, if any, that I wouldn't actually propose? Like, is rental numbers part of the decision or anything like that?
No. So with us, again, because we're just giving you short-term money, we kind of assume you'll never have a renter in the property while you have our loan. Now you may for a month or two until you get your refi, but no. So when we underwrite you from the beginning, we're doing it based on any liquidity and any income that you have. So unless that stuff goes away, right? So I'm going to ask you for an updated bank statement. I get you pre-approved, right? And then you come to me 60 days later or whatever and say, I have a contract. If anything major's changed on your credit, if you can't support the liquidity that you could at time of application, or at least enough to qualify you, then those would be the underlying factors, or the deal itself, right? So I may have pre-approved you at 90% of cost. And when we do that on what we like to call a vanilla fix and flip, which is, you're buying a property, it needs some, general cosmetic upgrades, that kind of thing. And then you come to me and say, oh, Susan, I got this deal. And usually we're looking at like a 1 to 4-plex. So you come to me and you go, oh, I got this deal and it's a 5-plex and it needs, major renovation and half of it needs to be torn down. I don't know. I'm just making this stuff up, but it's way outside of the scope of what we pre-approved you for. Those would be things that we might not even say, no, we won't do it. But I'm going to say, Amanda, well, I'm going to need 20% down on this deal. And, you're going to need to, I don't even know what else, but you know what I'm trying to say. So it'd be outside of the scope, or that you just really can't support what you could at the time of your initial application. Does that make sense?
Yes.
Yeah, so don't come with her for a strawberry when you qualify for a vanilla, okay?
No
love
banana splits.
I love like when everybody has like their own little like lingo within their office.
Yeah. Yeah, we're big on vanilla. I'm always telling people, okay, I got you qualified for a vanilla fix and flip. If you
Go
want
ahead.
something else, then
Pass Amanda along. She's got the vanilla.
But yeah, I mean, I have a lot of references and I could definitely give you some if you wanted, but I can tell you, we really do what we say we're going to do. And from the time that we get you pre-approved, and then once you're under contract and you send me the contract and you send me the budget and any updated stuff I want, like in a day or two, we're going to let you know. Yeah, we're still good to go, or here's the changes, or, when COVID first came up, we did have some investors that were being like super more cautious. And so people that were pre-approved, a month ago at that time, I had to tell them, well, sorry, right now we're going to require more down, or right now we're going to require a 6-month interest reserve. But, we've still done everything we can to keep business going, thank goodness, because that's important to us too. And it's important to us to perform on what we told you we would do. But, we all know there are changes in the market, there are changes in every situation. But, so far we have been able to maintain and stay the course, and maybe had to make some few difficult decisions, but like so far we have not been able to have to tell anybody, we can't do what we told you we're going to do. And we never tell people we're out of money. I mean, we fund about 25 million a month most of the time.
Yeah.
So we're not small, and we're not like some guy using his IRA and he's like, oh, sorry, I thought Joe was going to pay me off yesterday and he didn't, so now I can't do your deal. We have a lot of different investors and funding sources that we use that help us keep our capital going, because at 25 million a month roughly, we wouldn't be able to fund that just with our money. So we table fund everything, but then we sell them off. We still service them. So you're still only dealing with us throughout the process, with the exception of one of our funding sources.
So what percentage, just guesstimate, not gonna hold you to it, of your deals are being purchased from a wholesaler?
I would say 70-ish.
Yeah, I would say
But I have a lot
probably.
of wholesalers that refer me business too, right? So that also makes it maybe increased over people that don't work with as many wholesalers as referral sources.
Yeah.
But yeah, I have a lot of people that use wholesalers.
Yeah, there's tons of it going around, and
Mhm.
especially when I talk to a lot of different agents, I really try to talk about that, because a lot of them, they think it's illegal, it's not happening. I'm like, you knew how many closings are happening at your title company this week that have assignments,
Yeah.
they're being paid out.
Yeah.
You'd be pretty shocked. I said, actually, go talk to your title company. I swear they're happening all the time.
Oh my gosh.
So,
There's tons of them, and some are doing they close first and then you close with them. So it's not an assignment, right?
right,
It's an actual contract, but then some of them are truly assignments.
right, a
But
double
either
closing.
way, they're buying from wholesale.
Right, exactly.
Mhm.
So, just wanted to point that out, that you might think about it, and there are some really great ones in our market right
Mhm.
now.
Yep.
So if you guys need help with that, something we can work on.
For sure.
I have another question, and forgive me if I missed this. I've had some distractions with the 2-year-old.
No problem.
But do you have any minimum loan amount?
I don't really like to write much under 100,000. 75 is kind of my minimum.
Okay, thank you.
Mhm.
Do you have a sweet spot that you see a lot of your deals? Like I said, the one guy that I was talking to about 64109, it's funny because we're talking about his 5-bedroom. So I was doing an MLS search of all the 5-bedrooms that have sold in the last 180 days. And you could see there was a straight line going down Troost.
Really?
There is no houses east of Troost. There were over 5-bedrooms that sold within the last 180 days. They're all west. And I said, you can visibly see there's this big boundary. Now, when you open it up to 4-bedrooms, they're all over the board.
Mhm.
I'm like, so what does that tell you? You want to renovate this to a 4-bedroom,
Yeah.
then you're going to have comps, right?
Right.
That makes sense.
Totally.
It's kind of counterintuitive for a flipper, but again, this is something that I think about, I look at, because we want to have comps.
Right.
So with that, do you see like things like that with what you're doing? Do you see certain areas that are you see a cluster?
No, I can't say that I do, but I
I'm just
don't
looking for
really.
patterns.
I guess I don't really look at it the
Pattern
way
kind
you
of
do.
girl.
I guess I don't really look at it the way you do either,
Yeah.
but I always get people that say, I guess I'll just kind of not maybe rephrase what you asked, but answer it differently. But I always get people that say, are there places you won't lend in? And of course, to me, they're always referring to the urban core. And my answer is always, I don't really ever look at any of that, but the loan amount sort of rule that out in most cases, right? I mean, so I can't say that I've done really many loans, if any, in the true urban core, just because, when they call me and they want to do, a $40,000 loan, I tell them no. So, so that sort of a lot of times I feel like that rules it out. I have a lot in Ruskin. I have a ton of borrowers in Ruskin. One of my rentals is actually in Ruskin. So that is a huge pocket that I see a lot of people doing still, the BRRRR and that type of thing. And flip, I have people that flip in Ruskin. I have people that BRRRR in Ruskin. And then outside of that, it's just kind of all over the place.
Yeah.
You know, my guy that I told you I did about 16 loans for, I've done some for him in Ruskin. I've done some for him in Overland Park, Lenexa. So, you know, those are kind of his sweet spots. I can only think of out of 16 loans, those are the only 3 markets I can think of that he's done. 4 colonies in Lenexa, a few scattered in Overland Park, and a few in Ruskin.
Okay, one other question that's very similar. So when you see somebody do 1 in one area, do you see them usually do 2 or 3 in the same area?
Yes, absolutely.
And this is what I preach to a lot of people that are looking for deals. You can look and we can create a drip of on-market investment properties. This is actually, I just told one of your clients this. I said, and then circle that area
Yeah.
where there's one deal, and maybe you're not going to get it because it's on market. There
Right.
are more deals around there.
Right.
I see it all the time. I will
Right.
go to 3 or 4 houses on the same block, you know, for investors. So like that's huge. And they're going to have very similar problems. You know, if they're the Cracker Jack boxes, you know, houses like in Fort Osage School District, like all those houses look the same. You know,
Yeah.
those are great for flipping. Anybody? So like, because you're going to have comps. You're going to have a set standard for your renovations.
Right. Well, and then people see, you know, the work that you've done. I mean, I just know that my client that bought in 4 colonies, that's where I live. You know, he bought like 4 of them on not on our exact street because we just have these little cul-de-sacs, but they were, I think I financed 3 of them for him on 82nd Terrace, you know. And then people see the work that he does and they come to him and they're like, can you find me a house and fix it up for me? I mean, seriously, he gets people that ask him that, you know, because he gets known, and then he has like a guy out here again in 4 colonies, and he's a realtor, but he also bird dogs for him. So if he finds something, he might, you know, do it as, I don't know what you guys call it, a pocket listing or something, where he just works to negotiate between the seller and my borrower, and it never hits the market. You know, and then they pay him like as a bird dog or you know, some sort of finder's fee kind of thing.
Yeah, it's just one straight flat fee.
Yep.
Yeah. That's why I talk to investors when we're going out. Yeah, we'll just hang out for a while. We'll talk in front of the property. If somebody's walking a dog, I will stop and talk to them. If I see a dumpster in front of a house, I will stop and talk to them. You know, I'm like, we will stop everything and I will stop and talk to them.
And some of the neighbors are just like curious enough that they want to know what's going on, and you know, they'll talk to them. I mean, when we first moved here, my husband was like, how do all these people know we're from Colorado? I don't even know these people. But you know, the guy who sold us the house would talk to the neighbors and be like, oh, so I sold it to these people and they're moving from Colorado. My husband's like, how do these people know about us? You know, it's just kind of funny.
That's awesome.
It's all word of mouth advertising and marketing and whatever else you want to call it. I don't know.
Yeah. Yeah, I think that's great.
Yep.
Hey, ladies, thank you so much for this. I have to head out, but this was very, very helpful, so I appreciate it.
Cool. Thanks. Call me if you have any questions, Samantha.
Will do. I'll bombard you.
Okay. I anytime.
Thanks.
Nice meeting you.
Yeah, and if you guys want, set up a private Zoom with Susan sometime. You know, just talk one-on-one. Like I said, we're gonna try to come up with like an example and some real numbers, but you know, if you guys have something going on or have a potential deal or, you know, even see a wholesale deal that you know, see on Mari or whatever, throw it at her and just, you know, get some real numbers on it.
Yep.
So
I pre-approve people all the time. So
the more often you go through those numbers, the better you're going to be at looking at deals.
right.
So it's always repetition. Does anybody have any more questions? Oh, look at Stacy's little girl.
I can only see 3 of you.
Oh, okay. Oh, stop. You can shut down the share screen. There you go. Then you can open it back up. There you go. Awesome. I don't see any other questions in chat or anything, but all right. I guess if
Okay.
nobody has anything else, guys, I appreciate it. I'm glad you guys all came.
This
If
was wonderful. Thank you so much.
you guys have any questions for me, you can reach out to me on Facebook or in the group. You can just post questions in the group. I always like tell Amanda, I really just love you because she'll just have like something going on. She'll just like post it. I'm like, you're great. Anything that comes up, we're going to work on getting an insurance agent on the next one. So, and talking about just all the different types of insurance, because I've had a couple questions on top of what Amanda posted. So yeah, it's a big topic. And so if you want, think about questions, get them ready, and we'll talk next month about that. So
Cool.
yep.
Thank you, ladies.
Thank you.
Thank you all. Thank you.